Okay, thank you, Howard. I promise that's not going to be the only optimistic note that I sound over the next hour. So thank you all for being here. Thank you for being clients of PGIM. I think it's my job to set the stage, and I want to set the stage by lifting up and musing for a bit on the increasingly disturbing and disoriented world around us, and connect the dots with our day jobs to stay ahead of economics and markets. And the main point I want to leave you with is that none of the complexity, the uncertainty, and at times the horror of what we see in front of us is actually abnormal across the broad sweep of history. What was abnormal was the post-Cold War unipolar moment that paved the way for the great moderation of the global economy, roughly between 1990 and 2020. Here I'm just showing you z-scores smoothed over 5 years of real US GDP growth and core CPI, and you can see something very unusual happened in the 30 years after the Cold War. And that really was the outlier. So let's take a little stroll through history to make sense of how far we've come. I remember when Francis Fukuyama wrote a best-selling book in 1992 called The End of History. Some of you may have read it. It was, I would describe it as a premature celebration of the almost permanent ascendance of liberal democracy. Fukuyama called it the final evolution of mankind's ideological evolution. And to be fair to Fukuyama, I mean, democracy was ascendant. This chart, the red line shows you the number of autocracies in the world. The blue line shows you the number of democracies. And after almost 200 years of autocracies outnumbering democracies, after 1990, you can see the blue line really spiked like never before. So democracy was in, democratic capitalism was spreading, globalization had become hypercharged, global supply chains were spreading, and you can see that in the trade numbers. The blue shaded area is the share of exports plus imports as a share of global GDP. And in the bipolar era after World War II, you can see exports plus imports as a share of global GDP just inched up. But after the Cold War, you saw a doubling of world trade to global GDP from roughly 25% to above 50%. This was the era of hyperglobalization as it's come to be known. So democratic capitalism was in, global supply chains were prevalent, and the notorious isms of the 20th century, communism, totalitarianism, nationalism, were out. Geopolitical rivalries were fading. I mean, it's remarkable. If you look at this picture, this is the G8 in 1997. Russia had joined the G7, making it the G8 in 1997. That's Bill Clinton being flanked by Boris Yeltsin. And this was unquestionably the most powerful gathering of world leaders at the time. Now, you really have to look to the G20 to find the real players in the world, but it's as dysfunctional as it's ever been. China, of course, joined the WTO in 2001 after a decade of negotiations, and it quickly remade global manufacturing in its image. Here I'm showing you the share of global manufacturing value added. China's the red line. And pretty soon after WTO entry, China's share of global manufacturing in value-added terms was as much as the US, Japan, Germany, India, Russia, and Mexico combined. Thanks to Jim O'Neill, an ex-colleague, the BRICS became seen as the Beatles among emerging economies. I still think when the first paragraph of history is written about this era, it will include the fact that hundreds of millions of people in India and China in particular were lifted out of abject poverty and entered the middle class. Globally, we saw a boom of investment as a share of GDP at a national level, but also productivity. This is again smoothed over 5 years. The yellow line on the right axis references productivity growth in the US. It touched 3.5% to 4% on a sustained basis, and that's really what paved the way for above-trend growth alongside low and stable inflation. You can see now we've seen another run-up of sorts in investment. It's not yet clear whether those investments, this is really industrial policy, are going to translate into sustained productivity growth. I'll come back to that. Meanwhile, if I kind of make this a little bit parochial and talk about what was going on in the US, it was not just a unipolar moment. It was also somewhat of a bipartisan moment. This is just the fiscal picture. And there were 3 bipartisan budget deals that were reached in the 1990s, 1990, 1993, 1997. We started out the decade with a weighted average interest rate on our public debt north of 8%. Just for reference, now it's 3%. It was 8%. And after these 3 budget deals, we actually lowered the weighted average interest cost into the 2 to 3% range, and we ended up with a surplus by the end of the decade. You'll remember the Treasury, the US Treasury, stopped issuing the 30-year bond. Why was bipartisan fiscal compromise possible? Well, if you look at voting patterns in Congress between the Republicans and Democrats, the probability is centered in the middle of the distribution, not in the tails. And that prevailed for much of the 1990s. Now, of course, you can see the tails have become fat in both parties. Both parties have become more polarized, and of course, the differences between the 2 parties has arguably never been greater. Part of that bipartisan moment, I would argue, stemmed from the fact that most people received substantially similar information precisely twice a day. Once in the morning with their newspapers, and then in the evening with the evening news. And so there was not the atomization of media that we now see. We didn't live in echo chambers that produce a different set of facts and a different set of political views, and therefore policy. Well, all of that is over. That's the punchline. The unipolar bipartisan moment that paved the way for the great moderation in the global economy is over. I would argue it's not coming back. So the question we all have to grapple with is what comes next. And my answer is it's going to resemble to some extent the world as it's been outside of this unipolar moment. We're going to be in an environment of elevated volatility, uncertainty, complexity, and shocks for the foreseeable future. And I think these are at least 5 of the main trends as we do our economic research that are loosening the structural anchors in the global economy that characterize the era we've just left. So let's spend a little bit of time on these, each of them in turn. First, we all know we've entered a period of much more intense great power competition. But how do we link this to the global economy? First, just to kind of level set, democracy, I mentioned, was ascendant like never before in the 1990s. According to Freedom House, democracy has now been in decline for the past 17 years. The red line shows you the number of countries in which democracy is in decline within a country. The blue line shows you the number of countries in which democracy is still gaining ground. And you can see the red line has been above the blue line for almost the entire period after 2005. With more contested ideologies and competition in the forms of government, we're also getting a return of conflict. This is a measure by the UNDP on just interstate conflict, either directly or via proxies. You can see there was a dip between 1990 and the late 2010s, and now we're back to where we were. I would point out, it may be difficult to see this little shaded area in blue at the bottom. That is interstate conflict, one government in conflict with another. That's actually remained quite low, as you can see. My hypothesis is that the incidence of interstate conflict between governments remains low because many of the great powers, if not all, are nuclear powers. So there's a strong deterrent against a kinetic conflict escalating. But if that's the case, the path of least resistance for the international political economy will be more competition that plays out through economics and technology. And that affects everybody in this room that's trying to do their job. Sanctions and statecraft are going to be the tools of foreign policy that carry out this competition. My last job was in the US government, and designing sanctions, designing restrictive tools was very much part of what I spent my time doing after the invasion of Ukraine. But it's really a bipartisan trend in the US. The dark blue line shows you the number of new sanctions designations. The orange line shows you the rollback of those sanctions designations. And clearly the dark blue line column, they're greater than the orange columns, which means sanctions are sticky. And that's really the case for most statecraft, whether it's sanctions or export controls or tariffs or investment restrictions, asset seizures. Once you put them in place, there's a political momentum that makes it very difficult to later reverse those measures. So what do these measures actually do, though, to the global economy? I want to just dive into a case study of Russia 2022 and beyond that all of us have fresh in our memories. When the US government designed sanctions against Russia and the G7 followed suit, one of the key mechanisms that was used was what we called a capital account shock. So we thought by designating Russia's largest financial institutions and its central bank, we could create a negative feedback loop along the lines of what you see here. So generate a wave of capital outflows. That wave of capital outflows should lead to a free fall in the currency, absent capital controls. The free fall in the currency should lead to a spike of import prices and inflation. That forces the central bank to raise interest rates to prohibitive levels. That can get amplified by financial distress in the banking sector. That can lead to a flight of the country's talent and companies. And the velocity of that negative feedback loop is determined by the choices of the target country to escalate or de-escalate. And that's precisely what happened. There was a wave of capital outflows in the third quarter of 2022, about double what we saw during the pandemic, over $200 billion annualized during that quarter alone. This is the ruble, and a higher value here means a weaker ruble, went into free fall before recovering after capital controls. The free fall in the ruble led to a spike of inflation close to 20%. Nosebleed inflation caused the Russian central bank to raise interest rates to levels that they had never seen after the default of 1998. 20% was the policy rate, and now they're back up to 15%. And the economy fell into recession. The contraction was not as large as many predicted, including me. I would argue that the reason the depth of the contraction was not larger was President Putin made choices to limit the short-term contraction of the economy in exchange for sacrificing long-term growth potential. That's what capital controls do. That's what the weaponization of energy does. And that's what the 60% run-up in military spending has also created for Russia, is a bleak long-term future. But this is just one example of what statecraft can do, and every major power has tools that they're using. And it's going to be the world that we have to adapt to in terms of thinking about the economic cycle and the implications for markets. A second implication of great power competition is on coordination and cooperation. I would argue the biggest problems that we face don't respect borders. They are problems like pandemics, or climate change, or migration, or debt distress, or energy insecurity, or food insecurity. This is an example of what happens when you're in intense great power competition, is you don't solve these problems quite as easily. Those of you who focus on emerging economies, you know that the percentage of low-income countries that are in or near debt distress has doubled since 2015. The G20 attempted to address this problem by launching the so-called common framework for restructuring debt, but it's neither common nor is it a real framework. And as a consequence, many countries in sub-Saharan Africa, Asia, and Latin America have yet to meaningfully restructure their debt. And these debtor countries, in many cases, are paying more than a third of their tax revenues in debt service. So that's one of the consequences of a world in which cross-border cooperation is harder to come by. It's not all bad. There is a branch of the probability tree in which great power competition motivates a race to the top. And indeed, you can see in all major countries a renewed focus on enhancing the sources of economic competitive advantage. And that's really everything that is going on in the US and Europe and China to boost R&D, technology spending, infrastructure spending. And you can see that the share of GDP that's allocated from the US Europe, and to a lesser extent, China, has really been on the rise. Second trend that's closely related, just as we're competing more intensely across countries as we have in several decades, we are coming apart from within due to political polarization. There aren't many great cross-country longitudinal studies, but this is one that we take somewhat seriously. It's from the Carnegie Institute. And you can see that across the world, political polarization is on the rise, and the only exception really is in Europe, where it's not yet retouched the highs of the 1930s and 40s. But everywhere else, we're essentially at the historical highs, at least as far as this analysis goes back to the early 1900s. If you zoom in on the US, I mean, you can see that polarization has really gone parabolic since around 2010. And by comparison, if you just look at the US degree of polarization to Latin America, it makes the point. Latin America has hardly been a bastion of centrism, but the polarization in the US is now exceeding it by a fair amount. So what is the implication of political polarization? Well, I think one obvious implication for the economic cycle is we're likely to enter a period of so-called fiscal dominance, in which the actions or inactions of the legislative authority on fiscal policy dominate the choices of the central bank. And I think what it's leading to is a general disregard for deficits. If you look at where the US federal budget balance was before the pandemic, so in a strong economy with tight labor markets, it was the largest in peacetime history outside of a recession, 6.1% in the first quarter of 2020. Well, after 5 quarters of above-trend growth, just recently, we're back to a deficit of 6.8% in the US. 2 different parties in control, same outcome in terms of fiscal policy. I think this is likely to be a trend that stays with us. This is a more speculative implication of political polarization, the rise of organized labor. This is again a chart on the US, but for most of the past half a century, the share of national income generated by labor, so wages and salaries and compensation, has been on the decline. It's about 43% of national income as of the late last reading in 2022. Labor is increasingly organizing itself to do something about that. This is a chart showing you the number of work stoppages in the US, the number of days lost. These numbers are not a meaningful total out of the percent of our labor force. We have 170 million people in the US labor force. The number of workers that were involved in work stoppages is only around 200,000. But it's a trend that bears watching. We've been in an environment in which there were increasing returns to capital decade after decade. We may soon be in an environment in which there are increasing returns to labor. A third implication of political polarization is if we have less orthodox policy characterized by fiscal dominance, to what extent will policy still be seen as credible? This is a difficult concept to measure in real time. But if you look at confidence in the central bank, confidence in Congress, confidence in our main economic leaders, the trend is the same. This is a Gallup poll result asking respondents, do you have a great deal or a fair amount of confidence in the Federal Reserve Chair to do the right thing for the US economy? It was almost 80% during the early part of the Greenspan era. And it's been, with a little bit of an exception in the pandemic years, it's been on a decline. And we've gone from roughly 80% to just over a third of the people that have a high degree of confidence in the Fed to do the right thing for the economy. It's roughly the same outcome if you ask survey respondents about Congress. Doesn't matter which party you're talking about. Not many people have confidence in Congress to do the right thing. And if you think about this in terms of the rate of change last year to this year, we're seeing declines across the board for the preeminent economic leaders in the US. And I would argue the consequence of lower policy credibility is a higher risk premium on almost any cash flow producing asset. And we've seen this in treasury markets throughout the year. Everybody's been talking about term premium. The portion of the upward movement in the yield curve that you can't explain from Fed policy alone or from long-term equilibrium growth forecasts. There's a residual, and I would argue part of that residual that's been pushing yields higher is some loss of policy credibility, and this is a global phenomenon. Third trend is what's going on in the energy markets globally. We know there's a necessary transition taking place from fossil fuels to renewables, but will it be smooth? Will it be orderly? What will be the consequences for the global economy? And I think it's important to first think about scale. There's been an almost parabolic rise in the production of energy from renewables. You see those at the bottom of the chart. But if you add up all of the energy produced from those sources and you say what does the aggregate look like as a percentage of total energy production, it's around 20% of the total. And so it's going to take decades to get to a scale at which renewables can fully substitute for fossil fuel energy. Okay. In the meantime, investments in our legacy fossil fuel infrastructure have been plummeting. If you look at the number of refineries in the US, that's the yellow line, down by almost 40% over the past 30 years. The throughput capacity, which is the blue line, down by about 1.5 million barrels per day since the pandemic. And all indications are that capacity is not coming back. To make matters more complicated, there's a non-trivial share of fossil fuel production capacity that could potentially get weaponized for geopolitical reasons. Yes, the US and other producers have increased their capacity to produce oil and gas through shale deposits, but if you add up OPEC, Venezuela, Iran, Russia, I mean, there's at least 45% of the global oil and gas market that's produced by countries that are either adversaries or let's just say non-aligned with the West. It's not just a fossil fuel risk when it comes to weaponization. Even in the clean energy supply chain for electric vehicles, there are choke points held by China in particular that could become quite important, quite disruptive as geopolitical competition continues to intensify. Just to give you a frame of reference, the largest share of oil producers globally is around 10 to 15% of the total. But if you look at choke points in lithium, cobalt, nickel, manganese, graphite, the actual processing of those minerals, China controls anywhere from 60 to 90% of many of those processing steps. And that's what's coming. That's what's right in front of us. The implication from my perspective, from our perspective, is we should be prepared for recurring bouts of imbalance between energy demand and energy supply. The EIA projects that we're going to end up in an immaculate equilibrium and there won't be any meaningful economic implications. We have a different point of view. We think at least over the next decade, you are going to see shortfalls of energy supply relative to energy demand. That's going to have predictable consequences for energy prices, headline inflation, for the anchoring of inflation expectations by central banks. It will put pressure on fiscal authorities to shoulder the most vulnerable during the winter months. And there will be large balance of payment shocks, winners and losers between commodity producers and consumers. Last two trends, and I'll go quickly here to leave some time for questions. Global supply chains. You know, I know nobody reads G7 statements. I used to negotiate them, so forgive me. But in the last G7 statement, I was struck. There were 20 mentions of China. If you go back 3 years ago, and this was the convention, there was no name calling. There were no mentions of China. In almost every instance, the 20 mentions of China in the Hiroshima Leaders' Communique of last year was referencing de-risking. De-risking critical goods and technology supply chains from those of G7 countries, which is half of the global economy. This is not just a talking point in communiques. If you look at the hard trade data, the composition of US imports, the share coming from China used to be well above 20%. That's the red line. There is a very clear trend, downtrend, in China's share of US imports, and a very clear uptrend in imports from ASEAN, from Mexico, from Canada, from the EU. The compositional shifts are in the data. They're not ahead of us, they're right in front of us. There's also going to be an implication for global efficiency, global productivity, because going back to the chart I showed you earlier, if China is roughly 1/3 of global manufacturing value added, and it's 1/3 of global manufacturing value added because it's the most productive low-cost center, then it stands to reason as those production centers shift to less efficient, less productive sources, there's going to be an implication for economies of scale, for efficiency, for productivity, and for costs. More generally, if you want to just broaden out the point, I showed you this chart before. I don't think this is the end of globalization, but we are seeing a plateauing of it, a slowdown in the growth of world trade as a percent of global GDP. The green shaded area is where we are now. And you can see there's no collapse that's taking place in global trade, but we've certainly started to flatline. And the composition underneath that flat line has changed. Again, it's not all bad news. The corollary of slowbalization is the rise of industrial policies that are designed to create more productive capacity within G7 countries, but China and its allies are doing very much the same. This is a chart showing you that in real terms, the manufacturing construction, actual building of factories like semiconductor fabs or EV battery plants, is up threefold last year to this year alone. And to the extent that there's a virtuous spiral between factory construction, business equipment spending, and R&D, there is a case to be made that you could be on the cusp of another productivity revival where these policies are executed well. And lastly, distinct technology ecosystems. This is a related trend to the supply chain discussion I just raised. There are a set of technologies that the US, China, Europe, the UK, all major economies have identified that are foundational for economic growth potential, but also national security. This is the list from the US Commerce Department. And the reason why major governments are identifying which technologies are really critical, if you ask a US policymaker, their answer will be twofold. Number one, military-civil fusion in China. The number of mentions of military-civil fusion in Chinese official documents has really spiked. What is military-civil fusion? Well, the concept is there's no distinction between the commercial sector and the military sector. So if there are technological advances that diffuse from the US or the G7 to China, it's not purely commercial. There may also be a military application. That strikes fear into the heart of every US policymaker. And the second is Made in China 2025, which was announced in 2015. And the language that was associated with this program was to maximize the dependence of the world on China's production of these technologies and to minimize China's reliance on the outside world to bring these products to market. And so there are, again, two consequences. Number one, each major economy is making investments in its own capacity to produce these technologies. And you can see the numbers here. They're not yet staggering, but they're growing with each year. And you're seeing more controls. These are export controls placed by the US on Chinese companies. The yellow portion of the column is the incremental amount placed per annum. And you can see this is a bipartisan trend. When the Biden administration took over from the Trump administration, it inherited roughly 250 export controls, and it subsequently increased them to close to 450 over the past year. The concept of a small yard and high fence, I would argue, is just going to continue to grow in terms of its dimensions. Technology travels with capital, we know this. And so I think the next frontier of the movement to distinct technology ecosystems will be an FDI. This is the sum of US-China FDI flows. The yellow portions, the yellow columns are showing you FDI from China to the US. That's long had a screening mechanism called CFIUS, and it's led to outright declines in FDI moving from China to the US. What's new is an outbound screening mechanism. It was unveiled last year. That's meant to slow down sensitive FDI flowing from the US to China. That's still in positive territory. And I would argue that's going to be the next shoe to drop. Whether portfolio flows are also implicated, I think, is relevant to everybody in this room. And I can only tell you that if you listen to members of Congress from both parties, they will make the argument that if you buy a Chinese government bond, why isn't that money fungible in the same way that FDI is? And why couldn't that money be used for military applications in ways that threaten national security interests? So I'm afraid that when we talk about distinct technology ecosystems, we're also talking about capital. What's the cost of a technology war? The IMF has started to do some analysis. Lots of different assumptions you have to make in terms of the degree of polarity in the world. Is it 2 poles, 3 poles, 5 poles? And do the countries that are not one of those poles, do they align with each of them, some of them, none of them? The bottom line is for open economies like Europe or the UK, the costs are the highest. And you can see the numbers for Europe are anywhere from 4 to 6 percentage points of GDP. Over the next decade for China, it's 4 to 10 points of GDP. For the US, it's somewhat less. The UK, I would argue, is probably closer to the European case than it would be the US. Okay, so just summing up, why should we care about all of this in terms of the day-to-day navigation of markets? Well, markets are already trying to price in what is the new steady state for the structural regime we've entered. I think most people would agree we're not in the unipolar moment, we're not in a bipartisan moment, we're not in the great moderation of the global economy. But where should equilibrium interest rates be? The market's taking a view right now. It's saying the Fed is wrong. The Fed has said their long-term nominal neutral rate is 2.5%. If you look at the interest rate forwards that historically correspond to the market's view of where equilibrium policy rates should be in nominal terms, market's saying it's much higher. And we agree with that. All of the trends I showed you, they reinforce each other, they have compounding impact, and they have a tendency to push up trend inflation. I think you probably got that from my remarks. And that will have a tendency to push up the trend level of interest rates as well. To my mind, the implication of these trends on growth is more ambiguous. And it really depends on the success of executing industrial policies. I have some degree of optimism in the US. I have less optimism in the European case, and especially with China. But that's really what animates our research agenda. So as you read our reports and our publications, we're trying to approach these questions with analytical rigor and to try to break new ground on putting numbers to the kinds of questions that I was raising in this conversation. And I hope you'll engage us in conversation as we try to sift out the answers. So thank you.